Hey everyone, hope you had a great weekend. My name is Simo and I am an equity research analyst at Investment Research. Today is November 24th on 2025. We are here for our daily analysis on this company, and just as a side note, I will also be covering other stocks today, I guess. Specifically for this company, I am personally invested, unlike some of the other stocks I cover, which are analyzed purely based on your requests. And from my perspective, I am very optimistic for the future of this company. Okay, so today I will record full video to give you full picture of today's analysis. We're seeing is building a compelling case for why this stock deserves serious attention from investors right now. The stock is trading around $26 after pulling back from the $33 high we saw earlier this month. I think we may finish session of today with $27 to $28, which is good for day trading. That 11% correction from the peak has people asking the obvious question about entry points. But before we get there, I want to walk through the fundamental data that's driving institutional conviction and why the risk-reward setup looks increasingly favorable. Starting with the most recent earnings results, because this is where the story really begins. SoFi reported Q3 numbers on October 28th that crushed expectations across the board. Revenue hit $962 million, with adjusted net revenue up 38% year over year to $950 million. That revenue beat came with adjusted EBITDA jumping 49% to $277 million, which translates to a 29% margin. When you look at the actual guidance raise, management lifted full year adjusted earnings per share to 37 cents from 31 cents previously, and that new target sits above the 32 cents Wall Street was expecting. This isn't a company barely scraping by on profitability. This is a business that's demonstrating operating leverage at scale. What's even more impressive when you examine the segment breakdown is how the business mix is transforming. Fee-based revenue reached $409 million in Q3, up 50% year over year. That fee revenue now represents over 43% of total adjusted revenue, and this metric is critical for understanding valuation. Fee-based income from wealth management, subscription services, and payment processing carries higher margins and more predictable cash flows than interest-based lending revenue. Banks and fintech companies that generate substantial fee income consistently trade at premium multiples because the earnings quality is simply better. SoFi is engineering exactly that transformation, while Wall Street is still pricing it primarily as a lender. The member growth trajectory supports continued revenue expansion. The company added 905,000 new members in Q3 alone, bringing the total to 12.6 million, up 35% year over year. They also added 1.4 million new products to reach 18.6 million total products, up 36%. These aren't vanity metrics. Every additional product per member increases lifetime value and reduces the probability that someone switches to a competitor. When you can get a customer to use your checking account, investment account, and loan products simultaneously, the switching costs become prohibitive. That's the moat SoFi's building, and it's showing up in the numbers. Now let's address the analyst rating situation, because this is where the market inefficiency becomes apparent. Looking at current coverage, SoFi has received 11 buy ratings, 11 hold ratings, and 6 sell ratings recently, with an average price target of about $27. But that average masks significant disagreement. The range runs from $12 on the low end to $37 on the high end. When you see that kind of dispersion, it tells you the market hasn't reached consensus on what this business is worth, and that creates opportunity for investors who do their own work. Several major firms have been raising targets recently as the fundamental performance forces reassessments. UBS lifted their price target to $27.50 from $20.50. JP Morgan raised their target to $28 from $26. Most notably, Mizuho moved to a $38 price target from $31 previously, citing the strong rate-driven outlook and positioning to benefit from potential interest rate adjustments. These aren't minor tweaks. These are material revaluations based on updated models that reflect the improving fundamentals and business mix shift we are seeing in real time. The institutional buying wave we've been tracking adds another dimension to this analysis. We discussed earlier how JP Morgan increased their stake by 881% to over 46 million shares worth more than $1.2 billion. That wasn't an isolated event. When you look across the institutional landscape, Vanguard added over 800,000 shares, bringing their total above 100 million. ARK Investment Management more than doubled their position. These aren't retail traders chasing momentum. These are sophisticated capital allocators with teams of analysts running detailed financial models, making long-term allocation decisions. The fact that they're accumulating shares after the stock ran up massively tells you their forward-looking models justify current or higher prices. The credit quality story deserves attention because it's a differentiating factor that isn't getting enough emphasis in the market narrative. Personal loan net charge-offs declined 23 basis points to 2.60% in Q3. The weighted average income of borrowers sits at $157,000 with weighted average FICO scores of 745 for personal loans and 773 for student loans. In an environment where some analysts are talking about bifurcated consumer health with lower income borrowers facing stress, SoFi's prime borrower base becomes increasingly valuable. If economic conditions deteriorate, the company's loan portfolio should prove more resilient than subprime focused lenders, and that credit quality advantage isn't fully reflected in current valuations. The technology platform business is another growth driver that's underappreciated. The tech platform segment generated $114.6 million in Q3 revenue, up 12% year over year. Through Galileo, SoFi is powering financial services, infrastructure for other companies, and they're signing major brands. The partnership with Southwest Airlines to power their Rapid Rewards debit card launched in late October, followed by United Airlines launching their Mileage Plus debit card in early November. Both programs run on Galileo's technology platform. These B2B revenue streams are growing and add diversification beyond the core consumer app, and they're stickier because once you build infrastructure for enterprise clients, switching costs are enormous. Management's strategic moves around partnerships demonstrate their thinking beyond just consumer banking. The Southwest and United debit card programs aren't accidents. They represent a broader push to embed SoFi's technology into large established brands with massive existing customer bases. During the Q3 earnings call, CEO Anthony Noto mentioned they've signed 2 more major consumer brands that haven't been announced yet, which he described as their largest deals to date. If those partnerships materialize at scale, the technology platform could become a more significant growth contributor than the market currently models. Looking at the valuation framework, you need to consider what you're paying for and what the business needs to deliver to justify current prices. At $25 per share with roughly a $30 billion market cap, SoFi trades at a premium to traditional banks but at a discount to high-growth software companies. The average analyst price target of about $25 suggests the street sees modest upside from current levels, but remember that average includes both the bulls at $38 and bears at $12. If you believe management can execute on their guidance and maintain that 30+% revenue growth trajectory while expanding margins, then current prices look reasonable to attractive. The really interesting data point is how SoFi has consistently exceeded the Rule of 40, which measures the sum of revenue growth rate plus EBITDA margin, averaging 58% since going public. Companies that sustainably score above 40 on that metric typically command premium valuations because they're demonstrating both growth and profitability simultaneously. Most fintechs are either growing fast and burning cash or profitable but growing slowly. SoFi is doing both, and as more investors recognize that combination, multiple expansion becomes possible. On the institutional ownership angle, this is critically important for understanding future volatility and price behavior. When a stock transitions from retail dominated to institutionally backed, the character of price movements changes. Institutional investors hold positions for quarters or years, not days or weeks. They're less reactive to short-term news flow and technical patterns. As SoFi's institutional ownership has climbed to record levels with firms like JP Morgan, Vanguard, and others holding massive positions, we should expect more stable price action over time. That doesn't mean volatility disappears, but it does mean the wild swings we've seen historically should moderate. For retail investors, that institutional support provides a floor under the stock during broader market sell-offs and creates a more favorable environment for building long-term positions. The guidance raise from management carries weight because they have a track record of delivering on projections. The company lifted full year 2025 adjusted net revenue guidance to approximately $3.54 billion, representing 35% growth, and adjusted EBITDA to approximately $1.035 billion. They also project adding at least 3.5 million new members for the full year. When management consistently hits or exceeds their own guidance, it builds credibility with investors and typically leads to multiple expansion over time. The market rewards predictability, and SoFi is building that reputation quarter by quarter. Looking ahead to what drives the stock from here, several catalysts are in play. First, continued member growth and product adoption as the cross-sell strategy gains traction. The 40% cross-buy rate, meaning 40% of new products come from existing members, shows the flywheel is working. Second, margin expansion as fee-based revenue grows to 50% or more of the total mix. Third, potential upside from new partnerships and products that haven't been fully incorporated into consensus models yet. Fourth, any improvement in the macro environment or interest rate outlook that benefits lending volumes and net interest margins. The risk factors are real and shouldn't be ignored. Valuation leaves limited room for execution missteps. If member growth slows or credit quality deteriorates or the fee revenue transition stalls, the stock could give back gains quickly because expectations are elevated. Competition is intensifying as traditional banks improve digital offerings and other fintechs target the same demographics. Regulatory changes around digital banking or any future crypto regulations could create headwinds, and broader market conditions matter. If we see a recession or significant uptick in unemployment, even prime borrowers face stress and loan portfolios would see pressure. So what's the verdict on whether investors should buy the dip here? At $25 after pulling back from $33, you're getting about a 23% discount from the recent high. The fundamental business momentum is strong with 38% revenue growth, expanding profitability, and record member additions. Institutional investors are accumulating shares aggressively after doing deep diligence, which provides validation of the long-term thesis. Wall Street analysts are raising price targets as the model outputs improve with better data. The stock trades at a premium but not an insane multiple if you believe in the multi-year growth trajectory and business transformation. For investors with no position who believe in the digital banking thesis and think SoFi can execute on their plans, current levels represent a reasonable entry point. You're not buying at all-time highs, you're not chasing parabolic momentum, and you're getting in after a healthy correction that's shaken out weaker hands. The risk is that the stock could dip another few dollars before it moves higher, but trying to perfectly time the bottom is nearly impossible. If your time horizon is 2 to 3 years and you can handle volatility, the setup looks favorable. For those already holding shares, this isn't necessarily a moment to add aggressively unless you're significantly underweight relative to your conviction. The stock has already had a massive run, and while fundamentals support higher prices over time, near-term consolidation around these levels seems likely. The smart play might be to hold what you have and potentially add on any further weakness below $23 or $24 if we get another leg down. On whether this week sees green or red days, that's impossible to predict with any certainty. Short-term price action depends on macro news, overall market sentiment, technical trading patterns, and general fintech sector momentum. What we can say is the stock has institutional support around current levels based on the buying activity we've tracked. If the broader market cooperates and there's no major negative catalyst, we could see the stock work its way back toward $27 or $28 relatively quickly. The path of least resistance probably tilts slightly bullish given the fundamentals and institutional backing, but day-to-day movements are always going to be noisy. The bigger picture is that SoFi is executing on a strategy that very few companies have pulled off successfully. They're building a true digital one-stop shop for financial services, growing revenue at nearly 40% annually while expanding profitability, attracting millions of new members every quarter, and earning institutional validation through massive position builds. The business quality is improving every quarter, and while the valuation requires continued strong execution, the risk-reward for long-term investors looks attractive at current levels. This is a company that could genuinely become one of the dominant digital banks over the next decade if management continues delivering on their plans. That's the thesis, and the recent earnings results and institutional buying activity support it. That's my analysis for today. Thanks for tuning in, and I'll see you tomorrow with more investment research.